Hi everyone, my name is Mary Redmond. I'm talking right now about the pound dollar. So I do like the pound dollar. Actually, I did have a small short last night. I was actually just lucky on this one. I never like to tell other people what to do, but for myself I like it at the top of this channel going forward as a short position. And I think we could be on the cusp of what could be a pretty major, a substantial trend change in the pound-dollar pair. You can see that it hasn't really broken below its long-term upward trend line that started last May, although it has formed a downward channel since the beginning of this year, and there's a tight wedge that's forming, and that's probably going to break before the end of June, the beginning of July. So what we've seen recently of the last monthly economic reports, we've seen that there's been a concern about growth. There's been a slowing of economic growth in the UK. So that reinforces the expectation that the Bank of England is going to keep interest rates on hold. We saw with the employment report this morning, which was Wednesday, that there was an increase in the claimant count to 19,600, which was the biggest in 2 years, with a slowing of average hourly earnings. So that's a concern. And then you add that to, there were reports last week which came out. The housing prices were down 0.3% year over year, and the British pound industrial production was down 1.2% year over year. And we saw this morning in the UK, we saw that the consumer price indexes were, the consumer price index did come in 3.6% year over year. It was down just a little bit from its previous month's earning, but the only reason that the Bank of England would be raising rates now would be because of excessive inflation. And the inflation, if the inflation is moderating to a degree, it decreases the probability that the Bank of England would raise rates even more. So there's also a concern in the UK about the banks in the UK and their lenders' exposure to the debt in Greece, as well as some of the debt in Spain and Portugal. And it's been estimated that the UK lenders have approximately 25 billion in exposure to loans to Greece, as well as an additional 75 billion in pounds in exposure to Spain and Portugal. So as the EU continues to debate how to come up to structure the next program of bailouts for Greece, and Greece continues to implement these difficult austerity measures, there's going to be concern as to whether or not any of these banks are going to be writing off these loans and taking big losses, and that's going to be another weight on the pound going forward. And we saw with the dollar, the US dollar, the consumer price index came in slightly higher on a year-over-year basis. The consumer price index was 3.6%, and excluding food and energy, it was also higher than expected at 0.3%. So that's not really ernoughh to stimulate the Fed to raise rates right away, but it's enough to put some concern in people's minds that inflation is rising. And Mr. Bernanke has said that they are going to, if they have to, take a strike against inflation, and then they may have to raise rates before they reach full employment. So we still have the Fed going into the U.S. stock market, or not going into the U.S. Treasury market. They're continuing to the quantitative easing, which does put some type of cushion of support under the stock market, and it does weaken the dollar to an extent. But when we saw yesterday with the stock market, we saw a move towards risk appetite, and we saw the S&P go up. It didn't close at its high of the day. It kind of rallied, and then it faded a little towards the close. And the indication is that it's still in this downward channel. So my thinking is that it's possible we may hit another important support level of 1250, and we may need to see a bigger spike up in the VIX to maybe the 25 level before we start a real stock market rally. And we've also got, since we have a U.S. Fed meeting that next week, the liquidity next week is probably going to be pretty slow on Monday and Tuesday. There might not be that much to do. And what we're kind of in with the financial markets is something of a transition phase where market participants are not really sure exactly what's going to happen when the quantitative easing stops. And we're constantly hearing this situation with the EU being publicized every day. And that's a problem, and there's no question about it. And the fact is that it could lead to an economic downturn and more problems in the EU, which would spill over to the UK because of the geographical proximity. So when we look at some of the other charts of the cable pair, it did break below its 50-day moving average and its 10-day moving average. The 100-day moving average is coming in at 162.2, which does look like it's a pretty substantial support level. It may be hard to break that. We might have to have a real move towards risk aversion. But if that does break, I think it's possible we could have a move towards $1.60 in the coming days. And we also see that the twin RSIs did make a bearish cross this morning, and we're seeing a cross lower on the moving average convergence divergence. So as I said, I do think that this pair is going to continue to be one of my favorites for shorting on rallies going forward. And there's going to be a cap on any type of rally that the pound or the euro can stage while we're continuing to hear about this crisis management in the EU until there's some type of a clear intermediate term resolution. And it's always important to keep an eye on the stock market. The stock markets are showing that they had a correction of over 5%. It's not really a bear market right now, but there's considerable concern in the stock market, and we may be hearing from company earnings about slower growth going forward in the second half of 2011. And fund managers and investors are probably going to be taking a cautious approach until they have some type of clear resolution about this.